Welcome to our monthly View from the Edge for July 2021. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, and with me here today, as he is each month, is Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3Edge Asset Management. As we do at the beginning of each month, Eric and I will provide our most recent market outlook for the global capital markets, which is based on our proprietary research model. And as a reminder, the full print version of our monthly View from the Edge for July is always available on our website at 3edgeam.com. So let's get started. The end of June marks the end of the second quarter and the first half of 2021. And for the first half of this year, it was the U.S. equity market that continued to outperform most other asset classes. Beside the continued rally in U.S. stocks, perhaps the most important or one of the more important news items for investors last quarter may have come when the Fed announced during their June FOMC meeting that given the surprising strength of the U.S. economy, and even though they believe that the surge in inflation will be temporary, it is now likely that the Fed will need to raise short-term interest rates sooner than they originally intended. In addition, most recently, investors have also begun to worry that as the U.S. surges out of the other side of the coronavirus pandemic, the U.S. economy may have reached what is referred to as the level of peak growth. So now let me bring Eric into our conversation, and we can start with a quick look at our 3Edge View from the Edge dot plot for July 2021, showing that the Fed is not the only institution that has a dot plot. We'll take a look at our chart and have Eric explain that, give us an overview. So over to you, sir.
Great, thanks, Fritz. So what you can see here from the chart are not too many changes, some things more at the margins, but what we're going to focus on in today's video podcast, this month's edition, is our outlook on U.S. equities, developed Asia, specifically Japanese equities. I note that those haven't necessarily moved, but we want to talk about some things going on there, particularly in the model. And then focus on real assets a bit, both gold and commodities.
Excellent. All right, so let's get started. We'll take a look at the U.S. equity market, which I stated earlier, has had a very strong first half of 2021. So what are we seeing there in terms of our model research?
Yeah, so it looks like the Fed's convinced markets that inflation is transient, at least in the short term, but risks remain. Tighter policy, including the potential for tapering, that is reducing the bond buying programs, whether that be the Treasury and or the mortgage backs that they're currently engaged in, and or increasing rates sooner than market participants expect, which has already been rolled back. Those are fears that could be, upset the outlook for U.S. equities. The idea now too that we've reached this concept of peak growth in the U.S. is being uploaded around too. And one explanation that fits that narrative is the recent rate decline that we've seen, with the 10-year in particular dropping below 130 basis points now that we're into July. So, should this stay here longer, that narrative could take on a life of its own. Risks also remain in the U.S. regarding the inability of Congress and the Biden administration to take the current infrastructure package over the finish line. And a further concern, and we mentioned this, sounds like beating a dead horse here, but that the U.S. equity market valuations remain near all-time highs. Price to sales ratio, for example, ended June at 3.12 for the S&P 500, the highest ever on record, and is continuing to climb into July. So that's concerning. Now, all that said, it's not all bad, right? So there are some economic factors that we have in the model, particularly the positively sloped yield curve measures that we've created, along with the fact that those yield curve measures are actually steepening. That sets the economy up for continued growth. So net, it's a mixed outlook. That's why you didn't necessarily see a change on the chart, but a lot of moving parts under the hood.
Excellent. So now let's shift geographies in terms of equities and take a look at Japanese equities, which remain the model's highest ranked equity asset class on a risk-adjusted basis. As we know, in the first half of the year, at least in local currency, Japanese equity markets have done well, but the weakness in the yen has encumbered investment returns of Japanese equities, at least in US dollar terms. So what's the model showing us now?
Yeah, so as you noted, neutral year-to-date performance for Japanese equities, but on that currency hedge basis performed a bit better. the yen itself suffered a sizable 8% loss or thereabouts in the first half of the year, which is really what caused that neutral performance for Japanese equities. All that said, Japan does have a very heavy reliance on exporting, and a currency depreciation like this with a lag should really help equity values as foreign buyers of Japanese goods and services can buy more with their relatively stronger currencies. So, all of that said, things could be rocky in the short term with the recent state of emergency imposed around the Olympics. We may see a shorter term decline in the region that ultimately works itself out, particularly now with the weaker currency that may ultimately help the space. We had been seeing some signs of this concept we call this behavioral breakout, whereby if markets continue to climb, could attract further capital into the region in this virtuous cycle. That's still on the table, although potentially a little bit more outside potential now, given the recent news regarding the Olympics.
Excellent, great. So now let's take a look. Let's shift gears and look at real assets. So that would include both gold and commodities. Gold has struggled thus far in 2021, while broadly diversified commodities have proved to be one of the top performing asset classes this year. So it's sort of two different stories. But more importantly, what is the model showing as we look ahead in the second half of 2021?
Yeah, so gold definitely suffered a setback in June. Had been somewhat neutral on the year going in, and then suffered a bit in June with inflation believed to be short-lived now. Alongside, you saw this stronger rebound in the U.S. dollar, both negatives for gold. Behaviorally, because of that, gold may suffer some shorter term headwinds, but longer term, longer term, gold continues to be supported by negative and declining real interest rates. And we're seeing that now with the 10-year, with the nominal 10-year yield coming down. So that should be supportive for gold. And like gold, commodities may face that similar shorter term behaviorally driven headwind. As markets believe that market participants believe that the threat of inflation has receded somewhat. But commodities do remain attractive in the medium term due to their long-standing relative undervaluation, particularly versus equities. And continued U.S. dollar strengthening would be the biggest risk or the biggest headwind for this asset class. Yeah.
Excellent, great. So that gets us caught up in sort of the key areas that we wanted to cover here today in terms of our view from the edge for July. Again, if you'd like to take a closer look at our full view from the edge newsletter for the current month for July, it's always available on our website at 3edgeam.com. So that will do it for Eric and me. We will be back once again in early August with the next edition of our 3Edge view from the edge. Meanwhile, Steve Cucchiaro and I will be back at the end of next week with the latest edition of the 3Edge Week in Review. As a reminder, all of our videos are always available on our 3Edge YouTube channel and on our website. Also, please feel free to share any of our videos you think that someone you know may be interested. So until next time, thanks for listening.